Next guest, does he think they're meme stocks? He says the Mag 7 could continue to outperform, especially in a high-rate environment. Tim Seymour is here. He's CIO of Seymour Asset Management, a fast money trader. Thank you. Welcome.
They are not meme stocks. All right, sorry.
Yeah, but why are they? Okay, so let's take some of the superlatives. Apple is up more than 2% for 5 weeks in a row. We haven't seen that in 15 years. I mean, there's some eye-catching things going on here.
Well, you can make an argument. Obviously, there's the ones that outperformed in the first half. So you have your NVIDIAs, your Microsoft. Second half of the year has been Apple, which I think is doing this without the AI bid. I think this is really about their core business, which is what sets it up really nicely. What's fascinating is we probably did or could have had this conversation a year ago and said at 36%, if you include Broadcom, or 34 and change without it, that you weren't going to see this kind of a concentration at the top of the S&P ever again. And I think as we go into, here we are, and as we go into 25, I think the dynamics around equal weighted, which were looking so strong up until Thanksgiving and have underperformed pretty massively.
Why is that? Do we ever know why, or what does it tell you?
Well, I think it's a combination of just fund flows and where we've seen a little bit of the chase into year end. I think that if you think about, there have been catalyst drivers around Google. There have been catalyst drivers around certainly a handful of the other names. Even Amazon, I mean, their third quarter numbers were an inflection in profitability. I think there are places where there was a lag and there was an opportunity, then all the usual secular dynamics there.
So a lot of people would say, Tim, now that the concentration being what it is, the outperformance being what it has been, next year it's going to be a different. And I think it's hard to take that line of argument more seriously because we've heard it for about 10 or 15 years now. But there, at some point, and even beneath the surface, there's some churn happening. Netflix is no longer in there, but it could be.
Yeah, it could
Here
be.
Comes Broadcom. It's effectively. So what is that dynamic that you really want exposure to?
Well, and I think you have to think about this also from a valuation perspective. And people, when they bring up their forward valuation for the S&P, you have to understand that those concentrations we just talked about, these are companies, even outside of the higher PE names and even maybe NVIDIA, which isn't really that bad. But the bottom line is the concentration of the earnings profile of these companies is also really important. So if you look at these companies on an EV to sales basis, they're expensive. If you look at them on an EV EBITDA, I don't think any of them are, there's certainly, I would say, a lower portion of these Mag 7 stocks that are trading at the upper end of a range. In fact, the profitability, the year of efficiencies, all of this stuff, the gross margin profile.
Alphabet was crazy cheap until Gemini a couple of weeks ago. So even I'd be curious if Apple is actually trading at a higher multiple than NVIDIA right now. But, regardless, call it around 40 times. So the reason to stick with them then is you think, that this is where the earnings growth is? So we know the rest of the market is contributing more than it was a year ago. So is next year a case where we have rising growth in the big tech stocks and rising earnings growth amongst the rest of the market?
Well, first of all, and to dovetail what Kate's segment talked about, I do think you could be selling upside vol. If you own these names, selling covered calls 3 months, 6 months out, especially in your Googles and your Broadcoms, the ones that have rallied massively into year end, and I think it's a really opportune time to do that. I think if you look at the mega cap techs in the context of the uncertainty around where policy could go, where interest rates could go. I mean, there's been a couple big reports this week saying where the long end could go. Maybe it does, maybe it doesn't.
Right.
But that defensive nature, I still think that a lot of these names could be funding sources for that broadening of the economy, of the market. And I do think you have really difficult Q1 comps for this group and are things to be worried about. So I don't think it's going to be off to the races. It's hard for me to believe we're going to have the same off to the races. But again, back to Apple, I think at 27 times, forward 26 without a lot of AI priced in. And I don't think it is priced in. I think it's a gross margin story. I think it's still some of that sales dynamic. And I think it's really just holding U.S. market share.
In other words, when you think about the narrative broadly, you go, well, yeah, I don't know if this can continue. But when you look at the companies name by name, you see plenty of reasons to get excited.
That's right.